What's going on, friends? Chris here from Money Peach, and just me today. I've gotten a lot of emails and messages on Facebook over the past couple weeks in regards to the CARES Act, but more importantly, how it pertains to retirement accounts. There's been a lot of changes as it goes to retirement accounts, and so I put together, we're putting together this show right now to kind of answer some of those questions and give you guys some options on what you can be thinking about when it comes in terms of retirement planning. So. There's been major changes, okay, and it's just going to go into effect this year, and they're calling it the coronavirus-related distributions. Now, kind of back up a little bit. What's normal right now? So before coronavirus, before let's say February, February of this year, 2020, some of the things we would be looking at in terms of retirement would be this. If you had like a 401k plan or you were doing an IRA, the markets were good. Our investments were towards the top as far as the markets were performing amazing. I think it was like records we'd ever seen before. But as far as how much we can contribute to our retirement accounts, this year we could do $19,500 if you had like a traditional 401k, or you had like an IRA, or not an IRA, a 401k, a 403b, a 457 if you're a government employee. And then if you had an IRA, the limit was $6,000. And so that's kind of, that every year it goes up a little bit. A couple of years back, it was 19,000. And so that's what that looks like. That's all, that's remained the same. There's some changes that goes along with retirement accounts. And then also, for those of us who are watching or listening, who are getting ready to retire, or you're in retirement, you're over age 72. This year it's age 72. You have this little thing called RMDs, required minimum distributions. And it's basically Uncle Sam saying, look, I need that tax deferred money back. I'm serious. So we're going to force you to take money out of your retirement accounts, even if you don't need it, so you can pay ordinary income tax on it and pay the IRS. That has changed as well. So there's some big changes that have happened since March 27th, since the enactment of the CARES Act. So we're going to be talking about that. So what is normal, and then what has changed? So normally, if you needed money from your 401k or your 457 or your 403b, you had two options, okay? You had one option is, or you had three options, okay? Option number one is you wait till you're age 59 and a half, then you can access that money and you don't pay a penalty at all, okay? You just pay taxes on that. Now, what's changed is before there was a 10% penalty if you withdrew money from your 401k, your 457, or anything like that. If you withdrew money before you were age 59 and a half, you paid a 10% penalty. So I would always tell people, do not do that. Make it a last resort, because let's just say that you're in the 25% tax bracket, okay, or 24, we'll say the 24% tax bracket. You would go out and you would take the money, let's say you took $50,000, you'd pay 24% tax on that, which is $12,000. So right away you're paying the IRS $12,000. But then you're going to pay a 10% penalty. You're going to pay $5,000 on top of that. So if you were taking a withdrawal and you weren't age 59 and a half, you took the withdrawal of $50,000, really 17,000 of it goes away, and 5,000 of that is a penalty. So I would say, do not do that. It's just such a waste of money, right? If you think about it, there's other ways you can get access to money. Now, the other way to get money from a retirement account is to take a loan. And I like taking loans. I don't love taking loans on anything, but I do like taking a retirement loan before I like taking an early withdrawal. And here's why, is there's no penalty, okay? And you're paying yourself back with interest. So that's also something that we're going to be talking about that's changed a little bit, okay? So before we move forward, let me just start. I'll share my screen here if you guys are watching. If not, just listen or take notes. Some of the changes that have happened when it comes to the coronavirus-related distributions. The first thing you need to do is you need to think about, okay, am I eligible? Who's eligible? Okay, so right here, what I see is coronavirus-related distributions. They apply to this group of people. Okay, so if you, your spouse, or dependent have been diagnosed with the coronavirus, you are eligible. Okay. However, if you've experienced adverse financial consequences because you have been quarantined, you've been furloughed, you've been laid off, or you've had work hours reduced due to coronavirus, then you are also eligible. We'll move down here. If you are unable to work because of a lack of childcare due to the coronavirus, or if you own and operate a business and had to close or reduce hours, or if you've experienced an adverse financial consequence due to other factors as provided in guidance by the insurance. So basically what it's saying is any of these things pertain to you, then yes, you are eligible for what's called the coronavirus related distributions as part of the CARES Act. Now, what does that look like? Okay, here are the type of accounts that this will apply to. Okay, so think pre-tax retirement accounts. So if you have an account like an IRA or a 401k plan or a 403b or a 457 deferred compensation, you see that a lot with government. If you have those types of accounts, then these accounts are now eligible for some of the changes when it comes to the CARES Act. Now, what's the big change? Do you remember earlier I was talking about that 10% penalty, that 10% withdrawal penalty? Well, it's gone. It's gone in the year 2020. So that's huge. Think about this for a second. Remember, I just gave the $50,000 example. If you go out and you get a $50,000 withdrawal, okay, you go out and get a $50,000 withdrawal, early withdrawal. Earlier, you'd pay about $17,000, and that's if you're in the 24% tax bracket. However, there's that $5,000 10% withdrawal penalty that's been waived. So this is huge, right? This helps out a ton. And here's something else they added. Is remember earlier I said that the maximum contribution you can make in 2020 to your 401k, your 403b, your 457 is $19,500. That's the max. Well, that means if you that would be the max. However, if you withdraw any kind of money during the coronavirus related distribution period, you can add that back into your 401k and it doesn't go towards the maximum amount. So let me give you an example here. Let's say you planned on putting in the max $19,500 into your 401k. Okay, just using this for easy numbers. You planned on putting in the max. However, you take a $10,000 withdrawal. You're not going to take a penalty. Okay. Now let's say you want to put that back in because things change quickly or whatever, and it's November and you want to put that in. You can put that in. So technically, it would look like you were putting in $29,500, but you would be allowed to because you borrowed that money. Or you didn't borrow, you took the early withdrawal. So think about that, is you can recontribute what you've taken out and it doesn't count towards the amount you're putting into your retirement account. So that's also a big bonus, right? That's something else that's huge, right? So what is the maximum you could withdraw? Now there is a maximum, and think about this, the IRS has to put a maximum on it because the IRS would love the 10% penalty because that goes to them. So they're gonna put a max on this. In 2020 right now, because of this all going on, it is, put the notes up right here. It is going to be $100,000 in 2020 without a 10% penalty. Okay, so think about that. If you take $100,000 out, early withdrawal would be a $10,000 penalty. However, it's waiving the $10,000 penalty, and you can recontribute that, and it does not count towards your maximum contribution. Okay, and what that looks like in 2020, it is $6,000 for an IRA, and it is $19,500 for the 401k, 403b. And 457. Now, the next question I've been seeing is this: do I still pay taxes? Okay. Yes. The answer is yes. You're not getting around paying taxes. You're getting around the penalty, which is good, but you're still going to owe the IRS taxes. Because think about this: the money that you put into pre-tax accounts hasn't been touched by the IRS yet. It bypassed the IRS. It went in tax-free. It's growing tax-free. So if the money comes out, the IRS is still going to get their money. So I put an example here. It says here, if you have a $50,000 withdrawal and you're in the 24% tax bracket, that means $12,000 of that is going to be owed to Uncle Sam. But guess what? The good news is now it could be extended over 3 years. So it used to be the taxes were due up front, but now in this situation you have 3 years. So you can basically do $4,000 a year if you wanted to, and so that's just something to keep in mind. So if you are going to do an early withdrawal, you're not going to pay a penalty. You are going to pay taxes, absolutely. Okay. So I talked about, that's the withdrawal portion of the CARES Act. Now let's talk about retirement loans, what that looks like. Okay. So with the retirement loans, normally you can take 50% of the balance or up to $50,000. So it was a max $50,000, but let's say you only had $80,000 in there, then you could take $40,000. That'd be your max because you could take half of the balance. The change with that is now you can take 100% of the balance or up to a max of $100,000. So let's say you have $90,000 in your retirement account. Okay, you could take a loan instead of, earlier it was 50%. So earlier it was 45,000 would be the max. Now you could take a loan up to 90,000. You just can't go over 100. So if you have $150,000 in your retirement account, you could go up to 100,000. And so another thing too is, let's say that you have an active loan, like you had a loan you're paying on right now, and you had it before March 27th, maybe you're in year 1, year 2 of that, then basically you could push pause on those payments as well. So that was something else that I thought was really interesting, is if you have a current 401k or 457 or any kind of retirement plan loan, you can actually push pause on those payments for the remainder of 2020. Okay, so that was huge too. When can you get this loan? Unlike the withdrawal that goes throughout the entire year of 2020, for the retirement loans, you have 6 months from March 27th. Okay, so 6 months since the enactment of the CARES Act, you can actually go and get that loan from your retirement plan. Big thing here, you have to pay this back on time. Because think about this, if you don't pay it back on time, you are going to incur a 10% penalty for not paying it back on time. And you're going to think to yourself, oh my gosh, I'm paying a 10%. It basically becomes a withdrawal penalty. If you would have done the withdrawal, you waive the penalty. So I would say only go the retirement loan route if you 100% know that you're not going to miss a payment. 110%, I would say. If there's any reason you think that you could miss a payment and you're seeking cash, you need cash now, then I'd probably lean more on the withdrawal, the early withdrawal without the penalty. And the reason why is you're not going to face that 10% penalty, because usually a loan, apples to apples, is a better option, because if you don't pay it back on time, you take a 10% penalty, which is the same thing as an early withdrawal. But in this situation, since there is no early withdrawal penalty, I would say keep that in mind. So definitely keep that in mind. Okay, another big benefit that I have seen with this coronavirus related distributions has to do with required minimum distributions. Now, this is if you're 71 to 72 years old, because it just changed in the last year. So let's just say you're 72 years old. What happens basically is you have to pay, per your age, a percentage of whatever's in your retirement accounts. You have to take, even if you don't need the money, you have to take that money. And so like I said earlier, so the IRS can tax you on it. That's just the way it works. So the cool thing is, and I don't have this in right, but the cool thing is on these here, if you are doing required minimum distributions, you can push pause on that for the rest of the year 2020. Now that's a big deal, okay? That's a big deal, and I think you can see on my screen now, I have an example here. So let's just say that when you are doing RMDs, you are paying ordinary income tax on that. So let's say because of the balance you have in your account and because of your age, let's just use an example. Let's say that your income, your marginal tax rate income is $180,000, okay? But let's say $30,000 of that now is the taxes you're paying on your RMDs, on your required minimum distributions. Remember, before March 27th, you didn't have a choice. You had to make those payments, or you had to take those payments from your retirement account, even if you didn't need it. And then you had to pay tax on that. Well, what's changed now is you don't have to take those RMDs for the rest of 2020. So if let's just say, like I said, you made $180,000, but $30,000 of that was now because of your RMDs. Well, if you don't need to take the RMD, now what happens is your income drops into the lower tax bracket. So this is saving you money, right? Like if you look at the example, for those of you listening, you're not seeing this, but for people watching, what you're seeing here is you drop in from the 24% tax bracket to the 22% tax bracket based on what the IRS has set for year 2020. So one of the recommendations is I would look at is I see a huge, huge opportunity. And the reason why is now, because you don't have to take those RMDs, I would highly encourage you to take the freebie and roll that or convert that into a Roth IRA. Because guess what happens? When it's a Roth IRA, you don't have to take the required minimum distribution. So you have this freebie. Now, here's what I would recommend. And I would obviously contact your CPA about this as well to get the exact numbers. But let's say you make $180,000, and let's say $30,000 of that was RMDs. Well, you now don't need to take those RMDs. So now your income is $150,000. You just dropped into the 22% tax bracket. So you save 2% in tax. Now, I want you to if I were you, I would want to put money in my Roth so I don't have to later pay taxes on those RMDs on a Roth IRA. Roth IRAs are just the opposite of an IRA. Money goes in after tax, grows tax-free, comes out tax-free. So it's the opposite. So let's just say that in year 2020, $171,000 is the maximum amount before you jump into the next tax bracket. So you want to stay in that lower tax bracket. So what I would do is I would take $21,000 of my IRA and I convert that and pay the tax on that to a Roth IRA, okay? Puts me at $171,000 for the year on income. I stay in the lower tax bracket. So it's a win-win. So if you're a retiree, there's huge opportunity here. So I think there's huge opportunity for everybody here if you want to use your retirement accounts in a certain way based on what the CARES Act has allowed. I think that's a huge bonus there. So I would definitely take a look at doing that. All right, let me come out here. So basically, the bottom line for this episode is this: if you are in a position where you know you need cash, you have two options right now that are different than they were 2 months ago. Option number one is you can take an early withdrawal without the 10% penalty. Okay, again, you're still going to pay tax on that, right? But you're not going to pay a penalty. It's penalty free for all of 2020. Option number two is you could take a loan. Now, loans I like better than withdrawals almost always, except for right now, almost always, because you're not going to pay a 10% penalty. But if you don't pay those back on time, then you will incur that 10% penalty. So kind of keep that in mind. And remember, a loan can only be taken out from the start of the CARES Act, which is March 27th, all the way through to the 6 months later. So you do have some options there, but just keep in mind, if you do need cash, there are options. I mean, think about it. Retirement money is still your money, right? You're the one that saved that. You're the one that put that away. So if you needed to, put food on the table, you needed to eat, this would be an option that I would look into as in addition to what we've talked about in the past with the Paycheck Protection Program or the stimulus check or mortgage forbearance or student loan forbearance or anything like that. Use all of these in combination so you can navigate through this time, but use, what we're talking about here is to your advantage. So, you have a plan. I would just say create that plan. So again, I'll put together all the show notes and links, and I'll even put the slides that we use for this. So if you're listening and you didn't get to see that, I'll put all those in the show notes. And so, yeah, I think we're going to end there for this episode. But really, just keep in mind that if you have a 401k, a 403b, a 457, an IRA, or anything like that, it's going to be beneficial for you to just keep in mind you do have options of what you can be doing with that money instead of just letting it sit there. If you needed access to it, and you needed access because you're at the point now where you can't eat, or I'm sorry, you can't do anything because you're out of money. This is an option, and it's a quicker option than waiting for some of these other programs to get started. Like, I know a lot of people have applied for Paycheck Protection Program, but how long is that really going to take? We're still waiting on stimulus checks for, I said the majority of Americans. So this is just another option to get you moving in the right direction. And so if you guys have any questions, if you're watching on YouTube, you're watching on Facebook, pop a question there. Let me know. I'll try to get back to you as soon as possible. And if you're listening on the podcast, you can go to our site. There's a place where you can say Ask Peach. You can ask a question there and we'll get back to you. So I hope this helps. I hope this is beneficial. Thank you guys so much for being here and listening, and we'll talk to you soon.